Hey, Richard. Okay. All right. So based on what you're talking about, there's multiple ways you can look at this market. So let's just take, for instance, this 4 hour um, part of US 30 in the last week. Okay. So you have to think in terms of price from where does price want to go to, and where is the liquidity, meaning where is the orders that had the banks need to basically take in order for price to make a move, right? So when you think about like this, like double bottom, this is a bunch of liquidity down here, which means like there's buy stops, right? So for instance, if or sell stops, because if someone creates a long position here because they saw this go up and then it created a double bottom, well, they're going to put their stop loss right here, which is going to create a sell stop, meaning that when they get stopped out, they have to like sell those orders back into the market, right? That's why they call it a sell stop or a buy stop. So if someone does something like this, thinking that this double bottom is going to create a new high and then price reverses, this would then be considered like a valid order block that took out all of that liquidity, right? Now, you have to understand is that this order block to your, like what we're talking about, if price decides to go higher than that order block, does that make that order block invalid? It does, but it doesn't invalidate the potential downside move, right? So we are in a bearish market here, right? Well, if you're trying to sell this order block, like you definitely got stopped out, right? Like if you just decided to sell this, think it's going lower, like there's a loss. Even if you went into a lower time frame, like we could, for instance, go into a lower time frame, I guarantee you there's a trade in there. But this is exactly why, like, if you're trying to go for huge pip sizes, that you need to understand where you are in the market, right? So let's just find this area. Let's go to the 30-minute. Okay. So let's find this area here. Okay. So if we were to go down to the 15-minute, let's take off this indicator. Okay. Let's go down to the 5-minute. We'll keep trying to find this price here. Okay, so in this instance here, you'd be looking for signs that price is going to change its market structure, okay? So as we're coming to this 4-hour order block, there's not a single thing in this order block that makes me want to buy or sell, right? We have a rally-based rally order block here, price respected it, right? You have an impulse, price respected that order block right there, right? And then you have another impulse, another impulse, price never came to retest it. So when you're thinking about block flow, I never would have entered this trade off this 4-hour order block. It just wouldn't have been valid. However, there is going to be a point where to the left, and I can't go all the way that far, but to the left around here, so let's just draw this out, right? So to the left around here in this area, there's unmitigated orders. Meaning that because price left this area so quickly, if you don't understand what I mean by mitigated orders and the wicks, like you'll notice the algorithm of how price moves starts to, these wicks actually have to retrace where price went to in order to fill orders. It's the only way the market moves efficiently, right? So as you have an impulse up, well, all of this leftover gap has to get filled, right? Because we had a fair value gap here. See that? Like there's no price that came into that, but then it had to retrace and fill that order. And it perfectly refilled that order, so that's a mitigated order block. It just keeps going higher and higher. But somewhere to the left was unmitigated price. So at some point, you're going to have a trade where price will start to mitigate. Now, as you can see here, this is your first inclination that price is starting to do something of interest. Okay, so you now have a rally-based rally, which is an order block formation that got broken. Okay, so I would be interested in this area here because inside of this single move, there was not a single 2-candle pullback, which created a normal market structure. So on the higher time frame, like a 10-minute, this would be one big impulse move to the downside that broke structure. Okay, so if that's the case, where is our trade? Well, there's your trade. right? So you could have then taken a trade off this order block here, put your stop above, and then you take that to, there's a 1 to 7 RR trade, right? And so this is how you can start to understand that you don't have to worry about what the hell price is doing in these order blocks if block flow is being created. Because this is all respected block flow. There's not a single break of structure here on a 2-candle pullback that didn't respect an OB, right? Because this is, again, this is an OB. And the same thing that Ann teaches on the higher time frame is happening on the 5-minute, where it's saying, okay, I've created a new high. Cool. So there's my OB that broke structure. Okay, it retested the OB. So you could have taken that trade, right? If you're talking about trading with block flow, like you could be entering these trades and you take them, there's a 1 to 4 trade, right? You got in on that order block, boom, it made a new high. You just made a 1 to 4 risk to reward ratio trade. And then price starts to roll over, and then you're saying, okay, cool. So price started to roll over, it's breaking structure. Let's wait for a retest back into it. Bam, there's your retest. Now, if you would have been into this trade for a long time, right, you could have let your winner run. So if you wanted to, you know, get it to 1 to 4 like I do, if you want to get this to 1 to 4 like I do, and then like leave 25% to run, right? So you would have moved your stop to break even right here. Stop's now break even. You let your winner run, and like this thing ended up going like, what was it? Like 1 to 20? Let's just do this. Right? So let's, like, what does this go to? Like, there's 1 to 14 risk reward ratio trade. So yes, the order block on the higher time frame was invalidated, but the move is not if there's unmitigated orders to your left, and there will be leftover orders, right? So same thing happens here, right? You look at this really nice 4-hour order block, but there's unmitigated orders up at this order block that had to get filled. And as you can see, price didn't respect this order block, right? So price didn't respect this order block. But if we actually now start to go into what market structure says, right? So you could start to look at other potential trades here. Now, again, you don't have a really good break of structure. Maybe right there you do, right? You got a multi-candle pullback, break of structure. You could have been waiting for price to come back into this zone. That might have stopped you out, obviously, right? And again, not every order block is going to make you a massive winner. But these setups right here probably happened better on the 1 minute. That's why I go to the 1 minute. Because this rollover would have given you a valid 1 minute order block. And again, that would have been a massive trade to the downside, right? So you got to start looking at, like, how does price move? How does price mitigate these orders? How does price, like, liquidate these sellers, right? Because, like, when you're talking about, like, this kind of thing here, there's liquidity here, right? This is a retail trend line. Well, there's orders up there that people have their stop losses up there. So what do you think price is going to do when it comes back up to it? Well, it's going to take them out. And then what is it going to do? Well, it's going to probably continue in the trend, and the trend is down, right? So you will protect yourself from losses and these mitigations that the market does if you can understand that above all of these wicks, there's orders that the banks want to take. And then you find your invalidated, what's called a fair value gap. So this actually would have been a relatively simple trade, because you see on the 5 minute this is going down. Well, where did price forget to fill? Right here. That wick to this wick was never filled. This is called a fair value gap. So I actually have a template that I put. This is a fair value gap. What happened? Price perfectly came into that fair value gap, mitigated those orders, and then proceeded to tank, right? You can look for those. These are high probability trades, right? Like right here, like where's your fair value gap? Well, your fair value gap is right here, because between this wick and this wick, you have unmitigated orders. Where's all these orders? The bank has to fill them, okay? So there is your short position when you're talking about sniping the market and you're talking about order blocks, right? That would have been a massive trade. Again, this is how I trade. Not only just with order blocks, I look for unmitigated price that I can actually take from the bank, because the bank is going to do it for me, and then boom, I ride the coattails of the institutional markets. So hopefully that helps. Let me know if there's any questions.